In today's segment, we're going to examine the securities that a condominium can invest in. This is in accordance with Section 115 of the Condominium Act, set forth by the Government of Ontario this June 7, 2021. An eligible security means a bond, debenture, GIC, deposit receipt, deposit note, certificate of deposit, term deposit, or other instrument that is prescribed that A. is issued by the Government of Canada or Province or Territory of Canada, B. is issued by an institution located in Ontario and is insured in accordance with the regulations of CDIC or FSRA, or C. is a security of a prescribed class. Let's do a breakdown of each investment. A bond represents a loan made by an investor to a borrower. When buying a bond, you're giving an issuer a loan, and they agree to pay you back the face value of that loan on a specific date with specific interest payments along the way. You can buy and sell bonds in the secondary market. After a bond is initially issued, its value will fluctuate like a stocks would. A debenture is much like a bond, but unlike bonds, are unsecured. This means that investors have no claim to the assets if a company goes into default. Since repayment is based solely on the creditworthiness of the corporation, they are typically only issued by companies with AAA credit ratings. These companies use their privileged status in order to borrow money without security and few strings attached. A GIC, Guaranteed Investment Certificate, is a very secure investment with low risk. There are multiple types of GICs, such as fixed rate, escalating rate, market linked. Let's compare the traditional GIC to the market linked GIC. The traditional GIC will pay a coupon, so get your interest payments and principal repayment at maturity, while a market-linked GIC offers the same principal repayment at maturity, but earns based off the performance of an underlying portfolio. This presents a higher potential return than the traditional GIC, as it provides exposure to the equity market. Let's say your 5-year MLGIC consists of the 5 big bank stocks in Canada. Well, for the next 5 years, the performance of those big 5 bank stocks will determine the return that you earn on your MLGIC. A deposit receipt is a receipt issued by a bank to a depositor for cash or checks deposited with the bank. A deposit note is a PPN or a PAR, so a principal protected note or a principal at risk note. Since PARs do not offer principal protection, we will not go into them any further. A PPN is an innovative investment product that, much like an MLGIC, offers principal repayment at maturity, and its return is linked to an underlying portfolio. Unlike the MLGIC, they are rarely insured by CDIC or FSRA. Finally, a certificate of deposit or a term deposit are simply other terms for a GIC. As a dedicated team at Foster & Associates Financial Services, and on behalf of Wright Wealth Management, I'm Evan Wright.